Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Joann Spadigam and Kevin Cummins. Okay, we're recording this on Thursday, straight after the ECB meeting. So let's start with you, Joann. By all accounts, probably not the most exciting meeting. Did we learn anything new today?
No, as expected, it was a fairly unexciting meeting. The ECB went for no policy hike as we expected and as markets expected, with nothing really new in terms of the guidance as well. I do think that in terms of the meeting, a couple of things really, I think, played quite well into our view that potentially we might see more rate cuts coming in and more quickly than the ECB also has expected. I think a couple kind of things really speaking to this. Firstly, I think there's obviously been this pretty big increase in the long end, really driven by the US, which of course has implications for the euro area as well. So there's been this kind of tightening in financial conditions in Europe that's not really been European led of late. There's also this idea that, even though even as we kind of progress into the next year, with inflation coming down, real rates do become more punitive. Given that inflation is coming down. So, there's this idea that even if the ECB does cut rates, that actually we are at kind of levels that are restrictive, even with those rate cuts filtering in. So I think those kind of 2 points were interesting, just coming off the back of that meeting, but really nothing really new in terms of ECB policy guidance for now. They are a bit kind of watching this labour market data, particularly the wage inflation kind of negotiations happening in Q1. So that's clearly on the mind for now.
One of the other things that we were watching heading into this meeting, not that we thought that we would get any kind of decision, but was, around any discussion on potential changes to PEP or, to the timeline for the runoff of PEP, I should say, or to the MRR, the minimum required reserves ratio. There's been a lot in the press recently, I guess, from all sides of the spectrum, doves, hawks, and what everybody thinks across the council in terms of what they would be doing. Did we learn anything new today on that side of the monetary policy discussion?
So it was really interesting on PEP because Lagarde essentially refused to say anything really on PEP and really retained this message that actually they did not discuss PEP at all at the meeting. I think that's fairly interesting given we've had so much from various ECB members about there seems to be this very big kind of move from the hawks to really bring PEP unwind to the top of mind. To me, it really did seem like they were exercising quite a lot of caution given that we've seen BTP spreads widen over the last few weeks. It did seem that they didn't necessarily want to rock the boat, and so instead of addressing it at all, they decided to completely not talk about it and defer really the conversation to a later date. In terms of our views, I don't really think it changes much. I think, with volatility, it makes sense that the ECB didn't want to add to pressures in the market. But for now, we do think that it's likely to come up in discussion later down the line. We're really expecting for the end of PEP to move forward from December 24 to mid 24, but really that a compromise will be reached, and that might actually only be a partial reduction in PEP. But for now, the kind of key takeaway from the ECB is we're not talking about it for the moment. To us, it might not have come up in the official conversations, but of course, I do think that there are unofficial conversations kind of floating around, and that the ECB is obviously actively thinking about this, as is evident from the various kind of speeches we've heard from the GC. So we didn't actually hear anything on MRR either this meeting. Again, not that surprising. There's not really been a consensus that we would hear anything from this meeting. Again, not rocking the boat seems to be the right kind of approach at this point of this policy cycle. But our expectation is that we could eventually see a shift in MRR to 2% in line with the normalization of policy, and that could come in the spring as well.
Okay, so boring is probably the right way to describe this meeting. Before we move on, because I think it's a bit of a central bank focus pod this week, obviously with the ECB and then the Fed and the BOE next week. But before we move over to the Fed and the BOE, I know that you've also been doing some work on what the supply picture might look like in the euro area. We've got a lot of, a bit more clarity than we did have in terms of government's projections for their deficits and their funding needs in the year ahead. How does that look like it's going to shape up versus what we've had this year, for example?
2023 was a pretty heavy supply year, and I do think 2024 really is going to have more of the same, really. We've taken in all of the kind of draft budgetary programs that have come out from various governments, and our kind of top level gross supply number for next year looks fairly similar to this year. We're expecting around 1.17 trillion in 2024 from around 1.21 trillion in 2023, and to be honest, that's just a rounding error given how kind of large issuance is going to be for the next year, in line with this year as well. And a couple of things driving this. I think one of the things is also higher redemptions for 2024, which increases the call on the capital market. And deficits are coming down, but they still are fairly elevated. For example, I think both France and Italy are still seeing deficits above 4% for next year. So the deficits are coming down, but it does seem to be fairly gradual. So another year of heavy spending is upon us. The added kind of pressure for next year really will be in terms of QT. We've had a year where QT has been coming in, but slowly and phased in for 2023, with kind of a phased approach being taken to PSPP for this year. Next year will be, I think, obviously a lot more in terms of QT coming into the market. We're going to have a full year of APP unwind. PEP is obviously on the table for discussion, and again, this adds to pressures there. So I think in terms of both gross and net supply, we could really see a year next year which is fairly similar to this year. And the term premium that's been really built into the back end of the curve, that's when US driven, I think, is likely to be here to stay with the amount of supply we've seen coming in.
So supply to remain a theme, I guess, for next year. Okay, Kevin, over to you then. Like I said, we have the Fed as well next week. We're in that busy central bank period. It's obviously not one of the quarterly meetings for the Fed nor for the ECB, but we will have a press conference. So what are you expecting to be the kind of key takeaways from the decision and the press conference next week?
Yeah, I think you're right in that we're probably going to see very little from what we know already. It's widely anticipated that the Fed is very likely to remain on hold and not change interest rates. I do think we'll have, the Fed always looks at the policy statement pretty hard and avoids trying to make too many tweaks, but I would imagine that they'll, alter some of the language, particularly in the current conditions paragraph, just to acknowledge the better jobs data that we had, for instance, in September, and there was some upward revisions to earlier months. So the tone of the description with regard to the labor market is probably going to be upgraded a little bit from what they had last time around on September 20th. And then, of course, this morning's GDP data showed, headline GDP up at nearly a 5% annualized rate. So I would imagine the characterization of the economic situation and economic activity here in the U.S. Remains fairly resilient. So we're probably going to get an upgrade there as well. But on the flip side, we may have insertion with regard to, the geopolitical concerns, obviously. And then it could also see some sort of acknowledgement that financial conditions have tightened since the meeting pretty significantly as well with the backup in rates. So those probably offset some of the more positive tone in the current conditions paragraph. But you're right, outside of that, we'll have a press conference. It's always interesting to see whether or not we'll get too much new there. I mean, Powell just spoke on October 19th before the Economic Club of New York, and he didn't have really a new driving message, whether or not, they are going to continue to move rates higher or lower, at some point next year. So I think we're going to get more of what we've already heard from him, so that we're not going to get, any sort of meaningful change that people need to rethink the end of the year. Now, of course, the Fed's dot plot as of September showed one more hike, and I think, for now that's fine. I think he can, signal that they don't know. They'll see. It'll come down to the data whether or not they'll fulfill that, projection they made in September, and it still seems reasonable, given that inflation still is, at a still elevated level. In this morning's report, the core PCE suggested that tomorrow's core PCE for September could come down to 3.6. We had been going into this morning's report at a 3.7, and the Fed's own Powell even went as far as last week in his prepared remarks, saying that that's what the Fed expects for the year-on-year change in September to be at 3.7. So tomorrow's news may be a little bit more encouraging from that perspective.
When do you think that they will start to sound, the Fed here, I mean, they'll start to sound more optimistic on inflation? Obviously the data at the moment on the activity side seems to be pointing one way, and that's really what's been driving markets. But at some point they have to kind of acknowledge the progress that they've made, and that they will likely continue to make, I suppose, over the next year when it comes to the inflation outlook.
Yeah, and from that perspective, I mean, the one other thing that I'd flag is on day one of the meeting. So next Tuesday, we'll get the Fed's kind of preferred wage inflation data with the ECI. So I would think that you're probably, our expectation is it's going to be a pretty favorable development, that we're seeing, further slowing in wages and salaries, for instance. So we are seeing some moderation of wage pressures. And I would think that, some of the doves may feel a little bit more emboldened to think that inflation is going to get back down to 2%. They'll, I think, keep, even fast forward through to the December meeting, they're going to have to update their projections for growth and inflation and the median run forecast. And, I would think that they'll still have inflation north of, right now they have 3.7% for year ending this year. It seems a little bit high. We're pretty noticeably below that, or more close to 3.25, a little bit above that. So I would think those numbers are going to come down. That probably gives them enough leeway to say, if the data fast forward a few weeks from now don't suggest, any sort of reacceleration or unexpected reacceleration in the labor market or on the inflation side, them marking down those numbers and saying, that they don't have any more hikes in their forecast for next year, for instance. And it's because, inflation has been coming in softer than what we had showing at year end. So I think they're going to still talk pretty tough on the inflation, kind of have this inflation bias in the statement, until they see probably somewhere of a 2 handle on core PCE prices, which on our own forecast, we don't have that occurring to the first quarter. So, it probably isn't something that they're going to necessarily declare victory and celebrate that inflation is moving back down to 2%, probably until sometime early next year, I would think. And by that point, I think the economy is going to be showing signs of vulnerability that, our expectation is by the middle of the year, we start to slip into a recession. So for the time being, I think they're going to continue to sound pretty hawkish with regard to inflation until, like you said, as long as the data have on the growth side continue to allow them to continue to talk pretty hawkishly on inflation. Job growth last month, for instance, in September was 336,000, and this morning's GDP was 4.9. So, it's the economy is much more resilient, and it's probably a theme that Powell's going to emphasize at the press conference this week.
How do you think that will or won't alter expectations for a hike in December then? Clearly the market, if you look at market pricing, that they're comfortable that the next week's meeting will be on hold, but chances, although it's not kind of base case that they might hike in December, chances are increasing and are higher that they might hike in December versus next week. How does that fit versus your view of what the policy action might be?
Yeah, and I think if you were to look solely at the growth data since the September meeting, then it wouldn't be out of the question for them to actually hike next week. But it's very much clearly communicated across all views from the FOMC. We heard, more officials between the intermeeting period this year, this particular one, than most all year, with this, cohesive, coordinated message, that they can kind of wait and see how things come, given the fact that rates are pretty restrictive already, and it allows them that flexibility, their forecast from September, for another hike by the end of this year, to see how things come. And presumably, and they want to see growth slow, they want to see the labor market continue to moderate, but inflation has come down, and it has allowed them to have at least some opportunity to go on what, now they didn't hike for 2 meetings, assuming we're right next week and they don't hike. And obviously, since this started back in March of last year, they went obviously very aggressively. Then they marked down the pace, and then they marked down, the timing this year, to start skipping meetings. But now this is back-to-back meetings. So I think the hurdle is pretty high for them to start to, assume further hikes into next year. But I think the data would have to support that they're just probably not going to skip 3 meetings or so, then throw that last hike in. I think they would have to see the inflation data start to reaccelerate, and then they would probably start to project, 2 or 3 hikes in their forecast. And that's not something that we're expecting.
All right, let's turn to the UK now, with the Bank of England up next week. So Imogen, there's clear consensus that there's going to be unchanged rates next week. How do you see things going next week?
Yeah, I think seems quite nice actually that we might have a trio of quite boring central banks over the next couple of weeks. But yeah, Bank of England, very much consensus for unchanged rates. I think the market has priced in a couple of basis points at this point, but really broad consensus that they won't hike, despite the fact that Hugh Pill, the chief economist, has been on the wire suggesting that it's a very finely balanced decision about whether they hike again or not. This is kind of the clearest consensus that we've had for a Bank of England decision of the last 3 meetings. So that would mean we think rates are on hold at 5.25. Our expectation is that this will be with a 6-3 vote. So that means that all or everyone who's still on the committee that voted for a hike in rates at the last meeting will vote again. I guess risks are that we get 5-4. So that's with Sarah Breeden, the new MPC member, also folding into the hike camp. We obviously haven't heard all that much from her, but when we did hear from her at her kind of parliamentary hearing ahead of being appointed to the committee, she did sound kind of quite consensual. And so it's our base case that she would vote with the majority, which would give 6-3. Of course, 5-4 would maybe be more helpful in terms of signaling how finely balanced they think that decision is, and how they view the risks to the upside still on their forecasts. But I don't think that either one would necessarily elicit a huge market reaction. We also don't expect any change to the forward guidance. I think we spoke on the podcast last time about the fact that the BOE have had this, kind of same language around, to the extent that they see further evidence of persistent price pressures, they will tighten monetary policy further. They've had that same guidance with that kind of upside skew for the last 3 meetings, where they've both surprised the market by hiking 50 basis points and surprised the market by not hiking. So it's a little inconsistent, you might say, with what they've actually been doing, but I don't really expect them to change that. The only kind of plausible or feasible change that you might expect at this point in the hiking cycle, given that we think that they are, in our base case, they've now reached the peak in rates, is that they could signal that more clearly. Remove that kind of upside bias in the forward guidance. But I think that might well be a kind of dovish shift too much, if you like. Central banks have very much been peddling still this kind of restrictive for longer narrative. And part of that is because they don't want markets to price in a particularly early or fast cutting cycle. And so, I don't think that the bank would want to endorse a kind of particularly dovish shift, let's say, in terms of markets pricing in an early pivot. This is one of the BOE's kind of quarterly meetings, unlike the Fed and the ECB, so we will get updated projections. We don't expect huge revisions. And, in any case, I think from a market's perspective, given how wrong they've been in the past, and B, the fact that the whole forecasting process that the BOE is now undergoing a review led by Ben Bernanke, I think that the market will take very little steer from their projections, but I think that they will still retain this kind of upside skew that they've had in terms of the risk on inflation, although perhaps slightly less pronounced than what we saw in the August MPR. All in, I think from a market's perspective, if our base case materializes in terms of unchanged rates, probably a 6-3 vote, no changes to the forward guidance, I'm really not expecting it to be a particularly market moving meeting. I haven't really spoken to anybody that thinks any different. And like I say, the market is very much priced for that as an outcome. So I'm hoping that it might be a relatively boring meeting next week, but let's see.
So aside from kind of bank rate, what are your views on QT? Do you think we'll see anything interesting from that?
Yeah, this is still very much a kind of ongoing discussion in the UK, despite the fact that we've had the annual decision on the pace of QT at the September meeting. The MPC kind of left open the door for potential changes in the future in terms of the operational details on QT. In the market notice, where it had a sentence that said something along the lines of, we reserve the right essentially to tweak any operational details. And they specifically highlighted that also includes, they reserve the right to kind of review the sales process, which they have at the moment, which is where they sell in equal sale proceeds across the maturity buckets. And so really they're hinting there at the fact that the door is open for potentially shifting it such that they don't sell in equal sales proceeds weighting across the curve. And I think here really what they're talking about is potentially shifting the weight of their sales towards the front end of the curve. There's kind of an open discussion around this, partly because they're locking in very big losses at the long end of the curve, the bonds that they're selling there, which creates problems, as we've been through many times on this podcast, in terms of the Treasury. When they already have very high funding needs, they also have to make the BOE whole on any losses that are realized on the active sales. And so selling bonds that are, crystallizing bigger losses than they necessarily need to isn't, necessarily a kind of cash efficient way for the Treasury to operate. But also, I guess it's, it feels more pertinent in a kind of rising rate and steepening curve environment that the BOE might be able to, I guess to a certain extent, limit the extent of the sell-off at the long end of the curve. The 2 points that I would make, and I've kind of argued for a long time on this pod that I think that any shifts to QT are quite unlikely and the hurdle for that is quite high. But I guess just on those 2 points, I think the Bank of England have long been quite clear that they don't really care about the cost of QT. That isn't necessarily their problem, and I don't think that they would adjust their own operational details because of the cost of QT. And the second point is just that, for a long time they have been, or they view QT as being very successful. If you read anything from the Hawks and the Doves, then they gave a kind of glowing report card for QT. And I think in that case, it becomes quite difficult to rationalize a shift and a change in those operational details if you think that what you've done so far has worked as expected and as you had hoped, particularly when you consider that the rise in long end yields that we're seeing in the UK hasn't really necessarily been a kind of UK-led move, actually. To the contrary, really, we've been at these yield levels or thereabouts many other times through this year where it has been UK-led, but this time it feels much more global and much more US-led. So against that backdrop, I think the BOE would struggle to kind of rationalize a shift in QT, because I don't think that they would want to suggest that the quantitative tightening that they have been doing, those active sales, has been what's kind of driven the UK rates higher and that curve steeper. So that was a very long-winded way of saying no, I don't expect anything on QT, but I do think the fact that they've kind of left the door open to changes will probably continue to weigh on front-end spreads. We've seen a cheapening in spreads really across the curve, but I think some of the cheapening that we've seen at the front end has been about this possibility that that QT could be shifted and they could sell more at the front end of the curve. And I think just leaving that door open, plus this idea that the DMO gradually will shift their issuance shorter as well, can continue to weigh on that part of the curve. Okay, that's probably enough for this week. We will catch up next week when we've had the Fed, we've had the BOE, and we'll see how the market has kind of digested everything from the ECB. No doubt we'll hear from sources over the next couple of days as well about whether they really did or didn't discuss PAP. Let's see. Thank you both for joining me. Thank you to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.